Picture standing in your front yard with a for sale sign while your neighbor across the street suddenly cuts their asking price by $50,000. Moves like that aren't random. They signal that a serious housing downturn is spreading across the Carolinas, far beyond a normal market cooldown. What was once a pandemic-era housing boom has now shifted into a clear financial hangover. Over the past few years, waves of buyers from the north moved south, chasing warmer climates and new opportunities, often paying extreme prices and making cash offers without even seeing homes in person. That frenzy has now stalled while inventory rises, mortgage rates pressure buyers, and high-paying remote tech salaries begin to fade. In some overheated markets, home values could potentially fall by as much as 46%, especially where prices had been pushed far above underlying fundamentals. At the same time, supply keeps building. Investors are quietly exiting coastal condos, and even mountain towns are pricing out the very workers who keep them running. This sets the stage for a road trip through the top 10 Carolina cities where the real estate bubble is now sharply correcting, showing just how quickly a booming southern housing market can turn into financial stress. Number 10. Greenville, South Carolina. As you head into the upstate region, it's easy at first glance to assume you've arrived in a thriving economic center, complete with stylish downtown breweries, growing businesses, and what looks like a strong job market. But what's unfolding on the ground right now tells a very different and far more uncomfortable story for homeowners trying to sell. There's a noticeable sense of strain in the atmosphere, as newly built suburban developments sit oddly still and quiet, almost like they were never fully occupied. Picture trying to sell a starter home while recent Redfin data shows active listings in the area have surged by 42% over the last year. At the same time, serious buyers seem to have largely disappeared from the market. Many sellers find themselves repeatedly checking Realtor.com, only to discover that the average time a home stays on the market has climbed to around 65 days. That's more than 2 months of constant cleaning, staging, and waiting for open houses that often don't bring in any real interest. Local MLS reports are also showing that roughly 30% of listings are now seeing price cuts, as sellers try anything they can just to attract even a single viewing. For many local families, especially those who were priced out during the influx of buyers relocating from places like Ohio, it's a painful situation, watching the value of their homes and potential equity steadily fade away. Even the rental market is feeling the pressure. Zillow data indicates a 3% dip in rental prices here, which suggests landlords are also losing their ability to hold firm on rates. To add even more strain, data from the U.S. Census Bureau shows that new construction permits have exceeded actual population growth by about 15%. In simple terms, too many homes were built too quickly for the number of people actually moving in. Builders kept pouring concrete without fully reacting to the early warning signs, and now the result is a significant oversupply that's weighing heavily on the entire market. It's tough to watch ordinary working residents get caught in the middle of this imbalance. Even the scenic downtown attractions like the waterfall park don't feel quite as impressive when homeowners are underwater on their mortgages. In hindsight, many locals believed this boom would continue indefinitely. They bought into the momentum, stretched their finances, and now they're facing the reality of a sharp and painful correction. Greenville was once seen as a safe bet for stability and growth, but right now, its housing market is sliding downward faster than anyone expected, like a stone dropped into the Reedy River. Number 9. Wilmington, North Carolina. As you make your way down toward the coast, you arrive in a postcard-like port city known for its historic riverfront and its well-known connection to the film industry. At first glance, it feels like the kind of place where living by the ocean would be a lifelong dream. But right now, that dream is starting to feel more like a financial trap for many property owners. Even the salty coastal breeze seems heavier when you realize your investment is losing value faster than expected. Imagine opening your mailbox and finding that your homeowner's insurance bill has jumped dramatically. According to the State Department of Insurance, premiums in this area have risen by about 40% within just a single year. For many people, that increase alone is enough to push them out of the market. On top of that, Redfin data is showing a sharp 25% increase in housing inventory, meaning more and more homes are sitting unsold and stacking up on the market. And in situations like this, buyers tend to disappear, not rush in. You can almost feel the shift as local Cape Fear realtors data reports closed sales falling by 18%. In other words, transactions are slowing down hard, and demand has dropped off a cliff. The Mortgage Bankers Association has also pointed out that mortgage applications in the area have declined by 22%, which clearly shows how high interest rates are shutting out many first-time buyers and young families. Meanwhile, Zillow estimates the average home price at around $415,000, a figure that feels increasingly disconnected from what most local residents actually earn. In a place that's supposed to feel like paradise, it becomes hard to ignore the reality of rising flood insurance costs and falling property values happening at the same time. It's understandable to feel for longtime locals who never expected outside investors to inflate their quiet coastal town to unrealistic price levels. Now, as those same investors start pulling out and selling off properties, regular families are left holding the risk in a weakening market. Think about someone working long hours at a local seafood restaurant, realizing their entire paycheck still wouldn't cover a basic mortgage on a modest home. That kind of gap shows just how stretched things have become. Over the past few years, rapid speculation and aggressive buying have clearly left damage behind. Seeing beautiful historic homes sitting vacant with weathered for sale signs slowly fading in the sun paints a pretty discouraging picture. Wilmington is now finding out the hard way that coastal housing booms don't last forever, and when they reverse, they can pull a lot of built-up equity back out with them. Number 8. Spartanburg, South Carolina. As you move farther inland, you enter a major manufacturing and logistics center that saw a huge wave of corporate investment over the past decade. It even picked up the nickname Hub City, but at the moment, it feels less like a success story and more like the center of a real estate downturn. All around, you can spot long stretches of newly built, cookie-cutter neighborhoods that now sit half-empty, practically waiting for anyone willing to buy. It's the kind of scene that raises questions about how quickly things shifted. Picture a local factory worker trying to purchase a simple 3-bedroom home. When they look into building department records, they discover that new construction permits actually rose by 28% last year. In other words, builders kept pushing forward aggressively, flooding the market with new housing. But demand didn't keep up. Realtor.com data shows that median listing prices dropped by about 4% in just the last quarter, mainly because buyer interest has fallen sharply. Talking with locals makes the situation even clearer. Many notice that institutional money and Wall Street-backed investors have started pulling back. Redfin reports a 45% collapse in investor purchases in this area, signaling that the financial backing that once fueled the boom is disappearing fast. At the same time, Bankrate data indicates that current mortgage rates are now pricing out roughly 60% of median income households in the county. That means a majority of local earners simply can't qualify for typical home loans anymore. To make things worse, CoStar reports that rental vacancies have climbed to around 9%, showing that even the rental market is starting to soften. What emerges is a familiar pattern. Rapid expansion driven by corporate confidence, followed by a sudden cooling that leaves everyday residents stuck in the middle. You see hardworking auto plant employees putting in 60-hour weeks, yet still unable to afford even a basic starter home. It's a tough reality for the people who keep the local economy running. Instead of being rewarded, many feel priced out of the very communities they help sustain. Meanwhile, out-of-state developers are now rushing to offer discounts and incentives just to move the homes they built during the boom. The speed of construction, combined with cost-cutting and expectations of endless growth, is now backfiring. As a result, working-class families who stayed through it all are watching a speculative bubble unwind right in front of them. For many, it feels especially unfair because they weren't chasing quick profits. They just wanted stability and a place to raise their kids. Spartanburg has shifted quickly from what looked like an industrial success story into a struggling residential market, and the change has happened faster than most people ever expected. Number 7. Winston-Salem, North Carolina. As you move into the heart of the Piedmont Triad, you find a city with deep tobacco industry roots that has spent years trying to reshape itself into a modern hub for healthcare and technology. For a short period, that transformation actually seemed to work. But now, the local housing market looks like it's dealing with the aftermath of that rapid rise. You pass by old brick factory buildings that have been beautifully converted into loft-style apartments, yet many of them are now priced far beyond what most buyers can realistically afford. Put yourself in the position of a seller checking the Triad multiple listing service and seeing active inventory surge by a staggering 52% compared to the previous year. In that kind of environment, it's easy for a home to get lost in the crowd and sit unnoticed for weeks. Zillow data shows another troubling sign. Around 28% of sellers were forced to cut their asking prices just in the last month alone, simply to attract any attention at all. The National Association of Realtors also reports that first-time buyers now account for only about 20% of the market. That's a major warning sign because it means the entry-level demand that normally supports housing stability has weakened significantly. On top of that, Redfin data indicates the average time a home stays on the market has climbed to about 58 days, stretching out the selling process and increasing pressure on owners. Renting isn't offering much relief either. Local housing authority data shows that renter demand has increased by 20%, largely because many people simply can't afford to buy at current prices or rates. For homeowners, it becomes a draining experience, watching a property sit empty for months while mortgage payments continue to add up in the background. It's especially difficult when you think about young professionals and medical residents who bought at peak prices, believing the city was on track to become the next major economic hotspot. A lot of that optimism was fueled by hype that didn't fully match the underlying reality. Looking back, it's almost striking to see how aggressively some homes were flipped with low-cost upgrades, like basic gray vinyl flooring, and then listed at premium prices. Many inexperienced investors took heavy losses here, largely because they treated a mid-sized southern city like it was a booming Silicon Valley-style market. At the same time, that correction has also spilled over onto ordinary families who were simply trying to achieve homeownership. Winston-Salem, in many ways, pushed too far, too fast. And now the housing market is dealing with the consequences as that overheated momentum burns itself out. Number 6. Charleston, South Carolina. As you head down toward the historic coastline, you're greeted by cobblestone streets, centuries-old mansions, and sweeping views of the harbor. There's no denying it. This is one of the most visually stunning cities in the entire country. But underneath that beauty, the housing market is starting to fall apart in a serious way. The air carries the scent of marsh grass, but for many investors there's also a growing sense of financial pressure and uncertainty. Imagine purchasing an expensive property expecting strong returns, only to then see an AirDNA report showing short-term rental income has dropped by 22%. The reality is that tourists are no longer willing to pay the high nightly rates that once seemed normal. Recent data from the Charleston Trident Association of Realtors adds even more pressure, showing that luxury home sales have fallen by about 35%. High-end buyers are quietly stepping away from the market. At the same time, Redfin reports that although median sale prices are still holding around $575,000, overall inventory has increased by 38%. That combination often leads to homes sitting unsold for long periods, slowly losing momentum. To make things worse, updated flood maps from emergency management agencies have caused insurance premiums to double for roughly 15% of homes located on the peninsula. That kind of jump can completely change affordability overnight. The Bureau of Labor Statistics also highlights another major strain. For many local residents, basic mortgage payments are now consuming around 45% of their income. That leaves very little room for anything else. Meanwhile, you can almost watch out-of-town investors and tech workers scrambling to sell off properties they once saw as easy money. Many of these homes are in flood-prone areas that were heavily overvalued during the boom. There's a certain irony in how some buyers treated these properties like guaranteed long-term investments, as if coastal appreciation would never slow down. That confidence now looks increasingly misplaced. For longtime residents, however, the situation is much more serious. Many service workers who keep the city running have been pushed farther and farther away from the center, turning daily commutes into exhausting, time-consuming journeys. Over time, the charm of Charleston starts to feel very different when you realize how dependent it is on an inflated and fragile economic structure. What looks like a historic paradise is also a system stretched far beyond its limits. Investors treated the city like a high-stakes game, assuming they would always win. But now the reality is setting in, and the losses are becoming impossible to ignore. Charleston is now facing the consequences of years of overheated speculation, and the adjustment underway is shaping up to be both sharp and deeply uncomfortable for everyone involved. Number 5. Raleigh, North Carolina. As you enter the well-known Research Triangle region, you quickly arrive in a city that, over the past few years, has been trying hard to position itself as the next major global tech hub. For a while, it really seemed like that narrative might stick. Across the area, large stretches of forest were cleared to make room for expansive luxury housing developments. But now that the rapid building phase has cooled off, the results are starting to look far less impressive as buyer interest disappears. Drive through some of the newest neighborhoods, and you'll find entire rows of brand new homes sitting empty. Wake County real estate records confirm that dozens of recently completed properties remain unoccupied, despite being move-in ready. According to Zonda housing data, builders are now offering an average of around $30,000 in incentives per home just to attract buyers. In simple terms, they are heavily discounting or sweetening deals in an attempt to move inventory. At the same time, Redfin data shows a 48% rise in active listings across the metro area. That kind of jump signals a market where supply is piling up much faster than demand. Zillow also reports that home values in the region have already slipped by about 4% from their peak, showing that prices are beginning to adjust downward. A key reason behind this shift is labor market cooling. The Federal Reserve Bank of Richmond has noted that tech sector hiring in the region has slowed by roughly 40%. Without those high-paying jobs supporting demand, the housing equation starts to fall apart. The Triangle Multiple Listing Service further shows that homes are now taking about twice as long to sell compared to the same period last year, reinforcing the slowdown. It's almost striking to watch large-scale developers, who once expected non-stop growth, now dealing with shrinking margins and slower sales. Many of them built aggressively, pricing homes at premium levels with the assumption that remote tech workers would continue flooding in indefinitely. At the same time, there's a real human side to this story. Many local teachers, first responders, and essential workers were gradually priced out of their own communities as outside money poured in, only to see that same wave of demand pull back when conditions changed. The level of overbuilding across the region is hard to ignore. You can barely drive a few miles without passing another newly constructed subdivision, advertising steep discounts, rate buydowns, and incentives just to attract attention. In hindsight, Raleigh expanded too quickly and leaned too heavily on a single growth narrative. Now the result is a market weighed down by thousands of vacant, overpriced homes that are struggling to find buyers in a much colder reality. Number 4. Columbia, South Carolina. As you roll into the state capital, you're met with intense heat and a wide, spread-out metropolitan area that depends heavily on government employment and a large university population. For years, the city's economic rhythm felt steady and predictable. But recent housing data is starting to tell a much more troubling story, suggesting a system that's beginning to strain under pressure. Across the city, you can spot newly built apartment complexes that look complete on the outside but feel strangely empty in practice. Imagine being an investor who bought property near the university, only to check CoStar data and discover apartment vacancy rates have climbed to around 12%. At that level, finding reliable tenants becomes a serious challenge. In the broader housing market, things aren't looking much better. The Consolidated Multiple Listing Service reports that single-family home sales have dropped sharply by about 24%, showing that buyers are stepping back in a major way. That hesitation is spreading quickly. Redfin analysts note that roughly 32% of active listings have required price reductions within just the past 30 days, a clear sign that sellers are struggling to meet market expectations. For many owners, it feels like constant pressure. Zillow's rental index shows prices holding flat, which might seem stable at first, but it becomes a problem when you consider that county property taxes have increased by about 10% at the same time. On top of that, the National Association of Home Builders reports that builder confidence in this market has fallen by 15 points, reflecting growing uncertainty among developers as demand weakens. Conditions on the ground feel harsh. Extreme summer heat combined with a housing market that seems to be cooling in its own unstable way. There's also a real human impact underneath all the numbers. Many state employees and university staff are working steady jobs with relatively stagnant wages, yet they're being squeezed by rising taxes and a cost of living that refuses to ease. At the same time, some small-time landlords who once relied on student housing demand are now finding themselves in a very different situation. The assumption that rental income would always be effortless is no longer holding up. Instead, many of them are dealing with empty units and higher mortgage costs, all while the expected demand from students and renters softens. Columbia is now going through a harsh reality check, showing that even a government-centered, relatively insulated city isn't immune to the effects of an overheated housing market correcting itself after years of aggressive growth and speculation. Number 3. Charlotte, North Carolina. As you approach the skyline of the country's second-largest banking hub, you're met with rows of glass towers that once symbolized unstoppable growth, but now seem to reflect a more uneasy economic reality underneath. This major metropolitan area drew in tens of thousands of young professionals over the years, all chasing high-paying finance and corporate careers. For a long time, that momentum made the housing market look unstoppable. But now, that flow of corporate money is starting to slow down, and in some cases even reverse, leaving behind a housing market that was pushed to extreme levels during the boom and is now under serious pressure. Put yourself in the position of an everyday buyer trying to make sense of the market. According to a recent Wall Street Journal report, institutional investors reportedly purchased 0 single-family homes in this metro area last quarter, a major shift compared to previous years. At the same time, large corporate players appear to be stepping back from the market. Canopy MLS data shows that housing inventory has surged by about 55%, meaning supply is piling up at a rapid pace. That oversupply is now hitting demand directly. Redfin reports a 29% drop in pending sales, which signals that buyers are backing away and transactions are slowing significantly. Affordability is another major issue. Zillow estimates that the median home price, around $400,000, requires an income level that roughly 65% of local households do not meet, according to census data. On top of that, Bankrate data indicates that foreclosure starts in the area are already rising by about 8%, an early warning sign of growing financial strain among homeowners. A lot of the pressure comes down to how aggressively the market expanded during the boom. Many finance-driven buyers and investors pushed prices upward without fully considering long-term sustainability. Now, as conditions shift, ordinary residents are left dealing with the consequences of that rapid expansion. Many blue-collar workers who helped build and maintain the city's growth were gradually priced out of the very neighborhoods they worked in. At the same time, large investment funds that once bought up entire blocks of homes are now quietly reducing their exposure, leaving behind properties that are harder to sell and losing value. There's a certain irony in watching corporate landlords and speculative investors take losses after years of aggressive buying. But the broader impact on local communities is far more serious and lasting. Charlotte's rapid growth was built on the assumption of continuous financial expansion, but that expectation didn't fully account for economic cycles. Now the city is facing a clear correction in its housing market. In the end, it becomes obvious that no housing system can stay inflated forever if the underlying incomes and fundamentals don't support it. Number 2. Asheville, North Carolina. As you wind your way up into the stunning Blue Ridge Mountains, you arrive in a city that once had a reputation as a quirky, artsy retreat filled with independent spirit and creativity. Over time, though, that identity has been heavily reshaped by luxury real estate pressure. What used to feel like a haven for musicians, artists, and free thinkers now often resembles an exclusive, high-priced enclave where the housing market is beginning to come apart in a very visible way. Even the charm of local craft breweries can't fully hide the financial strain building underneath. Picture someone running a small local coffee shop and coming across an AirDNA report showing short-term rental occupancy has fallen to around 45%. That drop signals that the steady stream of vacation-driven income is starting to dry up. At the same time, Canopy MLS data shows a dramatic 42% decline in luxury home sales above $1 million. The pool of wealthy second home buyers that once fueled this segment has largely stepped away. Redfin data adds another layer, reporting that active listings across the mountain region have increased by about 60%. In other words, a growing number of homeowners are trying to sell at the same time, which puts even more pressure on prices. Zillow places the median home price around $480,000, a figure that feels increasingly disconnected from local economic reality. According to the Bureau of Economic Analysis, the median income for service-based jobs in the area is only about $40,000, highlighting a major affordability gap. On top of that, recent property tax reassessments have increased tax bills by roughly 25%, adding even more financial strain for homeowners already struggling with high prices. At that point, the math simply stops working for many locals. Owning a home becomes extremely difficult when wages are low, prices are high, and ongoing costs keep rising. For many long-term residents, especially those born and raised in the region, the changes feel deeply personal. A lot of them have been gradually pushed out as out-of-state remote workers and investors moved in, treating the area more like a scenic escape than a lived-in community. Meanwhile, large modern vacation homes and short-term rentals sit partially empty, generating losses for owners who expected constant demand. There's a growing sense that the market has turned against the very people who pushed it upward. Investors who once transformed the local housing landscape into an Airbnb-driven economy are now rushing to sell before conditions worsen further. What was once seen as a safe bet for profit is now becoming increasingly difficult to sustain. Over time, the aggressive pricing and rapid expansion have eroded the very cultural character that made Asheville attractive in the first place. The bohemian atmosphere that once defined the city has been steadily replaced by financial speculation. Now the market is going through a sharp reversal, and Asheville's real estate scene is experiencing a steep and painful correction after years of rapid, unchecked growth. Number 1. Myrtle Beach, South Carolina. And here we are at the final stop of the road trip. As you arrive, you're met with what many consider the ultimate tourist-heavy coastal destination on the East Coast. A neon-lit stretch of shoreline that has become the focal point of a major southern housing downturn. To understand how a market can potentially fall by as much as 46%, you only need to look at the oceanfront condo towers lining the boardwalk, standing like faded reminders of a long real estate boom driven by speculation and easy money. Now imagine being an investor watching the numbers come in from the Coastal Carolinas Association of Realtors, showing condo inventory has surged by an alarming 85%. That kind of increase signals a market overflowing with unsold properties. Redfin data adds even more pressure, reporting that price cuts are now happening on about 45% of active listings. In other words, nearly half the market is adjusting downward just to attract interest. At the same time, Zillow reports that the median time on market has stretched to around 75 days, meaning homes are sitting for long periods before selling, if they sell at all. Insurance costs are rising as well. State regulators have confirmed that wind and hail insurance policies have increased by roughly 50%, adding another heavy layer of expense for property owners. On top of that, property management surveys show that HOA fees are doubling in about 20% of older buildings, largely due to deferred maintenance and rising structural repair costs. For many owners, those monthly expenses are becoming unmanageable. This is where the so-called 46% decline scenario starts to make sense in practical terms. Imagine buying an oceanfront condo at the peak for $300,000. Then suddenly, your HOA fees double, insurance costs spike, and rental income drops by half. At that point, holding the property becomes financially impossible for some owners. In a panic, they might sell at around $162,000 just to avoid deeper losses or bankruptcy. That's where a severe 46% loss can materialize in real time. For many retirees on fixed incomes, this situation is especially painful. People who expected stability in their retirement homes are now being squeezed out by rising fees and declining property values. Meanwhile, some speculative investors who treated the market like a guaranteed profit machine are now facing heavy losses as they rush to exit their positions. What once looked like an easy money coastal investment has turned into a financial liability. Myrtle Beach is now dealing with a flood of excess inventory, rising ownership costs, and widespread investor panic, making it one of the most strained housing markets in the region. Finishing this journey leaves a heavy impression. It highlights how quickly working-class families can be pushed to the edge while speculative capital moves in and out of communities. What once was promoted as an affordable coastal dream across the Carolinas is, for many people, turning into a far more difficult and uncertain financial reality. Thanks for following along on the road trip.